So we're going to be looking at these three made-up companies and their various ratios to see what we can know by looking at the ratios. So this is all about interpreting them. Calculating them is not very hard if you remember the numerator and the denominator, and most people can just look them up. But understanding the computation, that's a whole other thing. So let's start with the current ratio. The current ratio is a measure of current assets versus current liabilities. And you want to have enough current assets, enough assets that are cash or near cash to pay the upcoming obligations in the near term. And so you want this ratio to be over 1. You want to have at least as many current assets as you have current liabilities. And current ratio is a little bit of a pass-fail. If it's over 1, you pass. If it's under 1, you don't pass. So here, blue doesn't have enough cash or near cash on hand to pay their liabilities. This is below 1. So that would be a troublesome signal. Yellow and red are both passing. And yellow is not better than red. They both have enough. And so having more than enough doesn't really matter. Enough is enough. Okay, gross profit ratio. That's a measure of sales minus cost of goods sold and divided by sales to get the gross profit ratio. And they all look relatively strong. If they have the same products, which we're not sure, they don't tell us here, then yellow clearly would have the better gross profit ratio. But if they are in different industries, then we would compare this gross profit ratio to other participants that sell the same thing. Because some items are typically high margin things like diamonds, and some products are low margin like diapers. So it's not really apples to apples to compare the gross margin between firms that sell different things. Inventory turnover, that's a measure of how quickly on average you sell your inventory. So a higher number is faster. And blue looks very close to once a month, 12 turns being once a month. Red is very slow, only 3 turns a year. That's on average every 4 months. And yellow is even faster than blue and red, selling 16 times. And we can convert that to days. Do you remember? We can take our 365 and divide by that 16.1, and we can figure out exactly how many days sales in inventory they have. So I did that on my calculator, and I got 22.67 and a little bit more days. So just under 23 days. So that's faster than once a month. Okay, so the next thing they give you is net realizable value. So that is accounts receivable less the allowance for uncollectible accounts. And it's not a ratio, but it's thrown in here just to see if there's anything you want to do with it. But there's not really anything we can tell because we can't see how big the allowance is versus receivables to see if there's a lot of problems with collections perhaps. We can't tell if this is large or small given the level of sales. We don't have any basis of comparison, so there's not much we can do with that line. The next line, days sales and accounts receivable. Unlike inventory turnover where they gave it to us in turns, here they actually give it to us in days. It makes it easier to interpret. Red is collecting much faster, much faster than yellow and blue. And I hope that yellow and blue have sales terms greater than 30 days, or else they're terrible at collecting. I hope they're closer to 60 days or 45 days. We don't know what their credit terms are on their sales invoices, and hopefully those number of days hover close to the due dates. Red being much faster than 30 days, it could be that they offer a very attractive cash discount, and many customers are paying in a few days in order to get that cash discount. But again, we don't know that. Okay, let's move on. Debt to equity ratio, that's a measure of how much the creditors have versus the owners. So yellow has 6 times as much debt as they do equity. So that would be enough for a creditor to be nervous. That's quite a bit above sort of the 4 threshold. Blue and red both have much smaller. 1.7 would be healthy and 0.9 would be terrific. So in terms of debt capacity, yellow's probably at it, and blue and red seem to be okay. Times interest earned, though, all 3 firms are too low. You want that to be 4 or higher. And so all 3 firms, for whatever reason, are not earning enough to comfortably be able to pay interest and other things and a cushion for problems. So all of them would be at risk in terms of being able to afford their interest. And so that's pretty serious stuff. All right, let's look at return on assets. Yellow and blue look like they have a nice healthy return on assets. Red's return on assets is probably below the cost of capital. I don't know what they're paying for debt, maybe 4%. And so if they're not earning enough to pay for the debt, then they should sell off assets and repay the debt until they have a better idea. Okay, return on equity looks pretty good for yellow and blue. I think most owners would be pretty excited about those kinds of returns. The 9% looks wimpy, and so owners probably would be unhappy with that, given that they can look at what they can get from yellow and blue. So they have alternatives. Let's look at asset turnover. Asset turnover of 2.9 would be very fast. Close to 3 would be like a Costco. So that would be getting customers to buy 120 rolls of toilet paper instead of 4. So that's really getting them to load up. Blue is probably average, between 1 and 2. And red, that would be very slow. 0.7 would be very slow. Dividend yield, that tells you how much the dividend is given the price of the stock. And so yellow's dividend yield is pretty average, between 1 and 2%. Blue's dividend yield would be considered very attractive. It's even higher in some cases than interest rates right now. So that would be a very strong dividend yield. Red is 0, probably because they don't declare a dividend, and you don't have to declare a dividend. The dividend payout tells you how much of the earnings per share was paid out in dividends, and so 10% and 17% would both be fine. Typically it's below 30%. Anything above 50% is usually eye-catching and a story you want to look into a little bit more. The price earnings ratio tells you how much the market is willing to pay for each dollar of earnings that you are achieving. So the lower the number is, the less confidence the market has in your ability to continue and grow your earnings. So blue here is apparently the most impressive from the market's point of view. It could be that they're pretty excited about that eye-popping return on equity. It could be that they are happy in other ways in terms of the industry that they're playing in. They have a few little problems. Their current ratio is a problem, and they seem to be at their debt limit. But otherwise, there are some happy signals. Hopefully their credit terms are 60 days and that 56 is not a particular problem. So that kind of wraps up the things we can know about these firms, gives us a chance to talk about how these ratios play out.